just based in some of the presentations that have come before, we've sort of established that there's around 50 million tonnes, 51 million tonnes, I think the last presentation said, of vegetation-based methods. My client base is typically Cobar based, which you saw from one of the presentations this morning, is the vast majority of vegetation-based methods in Australia. And at the moment, my client base represents about 15% of the Australian market for those methods. So dealing with this on a number of occasions have built up some some knowledge around the areas there. There's varying opinions out there in professionals at the moment as to whether it is primary production income or isn't primary production income. What I wanted to show you, I've been advising my clients from the start that it's not primary production income, and I'm very clear about that being a fact. Now, the reason is, there's probably two key reasons for that. The first thing is that you can literally go onto a website, go into Google, type in ATO carbon farming, and it will come up with a link to the ATO's website for Division 420 of the Tax Act. Now, I don't normally quote legislation to clients, but this is just so important because it's a very new piece of tax legislation. It's only been about in the past 4 or 5 years. Okay, so we're without internet at the moment. But literally you can go into your browser, search ATO carbon farming. It will come up with a link all about carbon farming, and it's got a box there, big red letters, that says any income from a carbon project where you generate ACCUs is not primary production income. Now, the basis for that is probably twofold. One, it's already been mentioned this morning that it's a financial product. So an ACCU is a financial product. An ACCU can be generated from changing the light globes in this roof to a lower emitting light globe. It can be generated from a coal mine. It can be generated from a waste dump, all things that are not primary production. So that's the first basis. A lot of people have said, well, why isn't a primary production when it comes from primary production land? Because that land has been used for the past number of years for primary production and will still be used for primary production whilst the project is active. So when you actually go to the Tax Act, and again this is something I normally don't do, but there's just been so much conjecture about it, this is actually section 995 of the Tax Act, details all of the things that can be primary production. So the one that we'd all be fairly familiar with in this neck of the woods, maintaining animals for the purpose of selling them or their bodily produce. So that's obviously very clearly primary production. When you go through the other items in this section, it does talk about a few things that you think might open the door for carbon projects on a tree-based method to be primary production, but it all talks about felling trees in a plantation or transporting, so actually doing the logging. So I guess just the resounding point I wanted to leave you with there is that it's certainly not primary production. There are accountants out there saying that they can make it primary production, but when you go back to the legislative basis, it is just so clear it's not primary production. It's very, very obvious. So that being so, it does put us into an interesting situation where the majority of these people in the Cobar-Burke district have been very used to primary production income. Typically sheep grazing, goats, a few cattle. Obviously in your neck of the woods up here, going to be much more cattle-based than it is sheep-based like in New South Wales. When we don't have the opportunity to use primary production tax averaging methods, so things like primary production averaging or farm management deposits, it can take out some of the opportunities for managing your tax. Now, as was mentioned this morning, you can get a very large amount of income in the first year. So I hope the back of the room can see that okay. This is just an example that I've worked on based on using a few different clients of mine, sort of trying to average out a 15 to 20,000 acre human-induced regeneration project and just modelling out what an income stream can look like from that and what the potential taxation implications are. So row 5 there, you've got the CFI income, so carbon farming income. The first year there's typically been a large payment, and it's larger than the following years because there's been some backdating to the projects. Now the backdating ceased at the 30th of June this year, so potentially into the future that backdating and that large income amount in the first year will change. But at the moment, even a lot of projects sold in the recent auctions still have that big backdating. So if you're looking at $450,000 income in the first year and then annual income streams of $225,000, which is highly achievable, we're talking total income over 10 years about $2.6 million, and that's per the contract. Now, if skipping ahead just to the bottom right-hand corner on that first page, you'll see that if you do nothing, you'll be looking at about $1 million worth of tax over the life of the project. Now, that's because you can't use primary production averaging for the first year, you can't use farm management deposits, and in some cases you can't deduct losses against that income. Now, when we start talking about losses, that's a very specific point. So in some cases you are going to be able to deduct them, some cases you won't, and that's something you'd need to take specific advice on. So the first thing there is that just assuming that it's being split between mum and dad, you've got the opportunity there, you've got the obligation there to pay about $1 million worth of tax over the life of the project, and that means that you're losing, in round figures, 1/3 of your income in tax. Now, the thing that you do have to be very clear on here is that this is a substantial income stream for those who are receiving it. If you've got any substantial income stream, you can expect to pay tax. It doesn't matter whether it's working in a job like I do, any other sort of business that you're running. If there's substantial income, you can expect to pay tax. But what we can do is just look at some of the other options which are available for structuring. Now, I'm still looking solely at the carbon project at this point in time. I haven't got into any of the primary production things that you can look at. We're looking solely at the carbon project. So where we start with the $1 million worth of tax in the bottom right-hand corner here, when we go down to the next scenario, it's reduced that by a bit over $300,000 and saved 33% of your tax bill. So this is a mock scenario that I've drawn up. And I think probably the easiest things to clarify here is that it is being put into place after you've signed an agreement with the government to supply the ACCUs. So once you've put into place that contract, you've got a legal obligation to supply that, and you can't just go changing the trading structure that you're operating in. If you're already operating as a partnership, you need to continue as that partnership, because otherwise you trigger nasty parts of the Tax Act. So what we can do is look outside of that arrangement, and the first suggestion would be that you can actually start a contracting company. So in a few of the presentations this morning, we've heard about the obligations to make sure that it's fenced, to exclude feral animals and the like, to make sure there's sufficient fire breaks there, to make sure that it's not going to burn down. It is possible for you to have a contracting company that you create yourself. Most people are going to be doing the work themselves, because that's the nature. Most people in the industry, that they prefer to do the work themselves rather than hiring a contractor externally. So registering a company, a proprietary limited company, gives you the opportunity to cap your tax rate at 30 cents in the dollar. Yep.
Would it be cheaper though? Would you get taxed less if you put it under a trust system at 28%?
So there's no 28% rate of tax. So that's just that might be an average rate that you've been told or talked about. We might come to a trust in a moment.
Oh, and I'm thinking of a small business entity. That's
Yeah. Yep. Okay. So there's a few different concepts there, so we might come back to those once I explain this one. And sorry, I am happy for people to jump in with questions whilst we're going as well, so please go for it if you think something's relevant at the time. So the benefit of putting the income into a company here is that it's all about reducing the income to mum and dad in the first year. So we started with $450,000 worth of income. We're taking out $250,000 worth of that to the company, which is going to be capped at 30 cents in the dollar. And then mum and dad have got $100,000 taxable income each. So we're saving tax in the very first year. Now, another part of this strategy was to move shares and move income out of the individual's name and move it into a superannuation fund. A superannuation fund hadn't been considered before for these people for some shares that they'd inherited, because quite frankly, they didn't have enough taxable profit from their farming operations to need to save tax. In the case of the carbon farming income, they now had that need. So because one of the, in this case mum, she was over 60, it meant we could transfer those shares into superannuation, claim a tax deduction for part of that, and also then generate the income within a super fund tax-free. So straight away we meant that we could take our off-farm income, our working and our dividends, went from 80,000 to 60,000 straight away, and then went from 80,000 down to 40,000 in the years after that. So That's a real saving over the project where there's $400,000 or $380,000 less income being declared at tax rates, and it's all being taxed at zero because it's in a superannuation fund. So for this client in particular, they traded it as a mum and dad partnership for 30 odd years. Actually introducing a company, introducing a super fund was all very brand new to them, but saved a substantial amount of tax. Now, when the strategy plays out, you can see in the first year, there's a $61,000 saving just in that year, and then the savings after that are about $30,000 a year. So it's all in all reducing your tax for a total of about $340,000. So coming to the family trust, when we start talking about family trust opportunity and structuring, it potentially might be that the contracting entity might not be a company, it could be a family trust. And the opportunity might exist where there's adult children who you could distribute taxable income to, or potentially even other family members or something like that. So a family trust is another option that you can certainly put into the mix, just not one that I've modelled here. So I think the thing to consider here is that this is solely based on the fact of what you can do after the fact, after you've signed a service agreement and after you've got a contract with the federal government. The biggest thing for you to take away from here today, though, is that all of your biggest opportunities exist if you see your accountant prior to actually signing any of those arrangements. So the opportunity here might exist that if you haven't signed up for a contract already, that you may be able to restructure your operation before you start. Now that might be something like transferring the land into a superannuation fund. There are some rules to pass around that, but certainly that can be very tax effective to do that. If anybody is over 60 and hasn't considered superannuation, they really need to start thinking about it. Don't think about superannuation as just what you hear in the news about the super funds are doing poorly based on share market going down. Superannuation is the most tax effective structure that you can find. So when you're going to have substantial amounts of taxable income, it's certainly the most important thing to consider in the overall planning. In this scenario here, we were too late to be able to transfer anything to a super fund, but what we could do is do tax-deductible super contributions of $70,000 a year. So that meant that I was taxed at a rate of 15% rather than at about 45 to 49% in their own name. So that certainly made an incremental benefit, but not as big as if we could have been involved a couple of months before everything was signed. Yep, another question?
Would you be able to use bring forward rules? Why do you bring forward rule for this?
As in the livestock deferral rule you're talking about, or the...
No, for assets and stuff like that, previously certain contributions.
Oh, okay, so that's a 3-year rule that you're talking about there. Yep. So what's being referred to there is the non-concessional contributions rule. You're allowed to contribute 180